After a choppy week, natural gas prices pulled back as warmer weather forecasts and strong output weighed on sentiment. The big question now, will the weakness continue, or is the market gearing up for another rebound? Let's break it down, starting with the fundamentals, then we'll jump into the technical picture and the forecast for next week. Right now, the fundamental setup leans bearish in the short term. Warmer than normal weather is expected across much of the US through mid-November, reducing heating demand and leaving the market with a demand shortfall. US dry gas production remains near record levels, averaging 108.7 billion cubic feet per day, up from about 107 in October, while storage sits roughly 4% above the 5-year average, meaning the market is well supplied heading into a typically higher demand season. On the international front, European gas prices are also sliding thanks to mild weather and strong supply, including pipeline flows in LNG, which weakens a potential export floor for US gas. Still, there is one key bullish factor to watch: LNG feed gas and export demand remain robust, with high export flows continuing to absorb a sizable portion of US output. On the other hand, the rise in the gas rig count is a bearish factor. The U.S. rotary gas rig total recently increased to about 128, up from roughly 125 last week and around 28% higher year-on-year. This signals that producers are preparing for more output, which could add further supply pressure and weigh on prices. Meanwhile, a new bearish factor is that LNG Canada has started production at its second unit. While this increases export capacity over time, it adds more supply competition in the short term rather than reducing the U.S. surplus. In summary, fundamentals are bearish in the short term, while weather remains the main wildcard. A colder shift early next week could temporarily soften the downside, but overall supply dynamics suggest continued pressure. On the technical side, the recent rally failed to break and hold above the pivotal $4.45 level, which now acts as strong resistance. Support zones to watch closely are $4.20 and then $4.10. Both representing recent swing lows where buyers may try to step back in. Momentum indicators such as the RSI show signs of being stretched and overbought, hinting that a pullback or consolidation phase is increasingly likely unless a strong catalyst appears. The technical picture supports the fundamental view of short-term weakness or sideways trade, unless a bullish shock emerges. For the next week, the outlook remains moderately bearish with around a 65% probability of continued downside or consolidation. The expected trading range is roughly between $4.10 and $4.40. Key factors to watch include weather model updates, LNG export flows, and weekly storage data. A colder 10 to 15-day outlook could flip sentiment bullish quickly, while continued warmth combined with high production and more rigs could push prices toward the lower end of the range near $4.10 or slightly below. So there you have it. Short term, the bias remains bearish as both fundamentals and technicals point lower. The current weather forecast is also bearish, reinforcing the downside tone for now, but keep a close eye on Monday's model update. Any shift toward colder temperatures could quickly change the market mood. If you found this breakdown helpful, hit like and subscribe. We'll keep tracking these developments and update you as we move deeper into November. See you next week.